Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the corporate jargon. And today we're diving into Triller Group Incorporated's latest financial report. Get ready because this one reads like a financial roller coaster with some serious ups and downs. Before we dive in, if you enjoy unraveling these complex financial documents and want more straight to the point analysis, make sure you hit that subscribe button. And hey, we have a fantastic community over on Discord linked in the description below where we talk all things finance, so swing by and join the conversation. Alright, so Triller Group Incorporated is filing an amendment to their quarterly report for the period ending the 30th of June 2025. Think of this as a do-over. They found some mistakes and omissions in their original filing and they're fixing them up. It is important to note that this amendment mainly corrects past information and doesn't reflect newer events. First up, let's look at their financial health from their balance sheet. As of the 30th of June 2025, they had total assets of about $45.4 million. Now that sounds like a lot, but when you look at their liabilities, which stood at a hefty $327.7 million, you start to see a problem. This means they owe a lot more than they own. And this is glaringly reflected in their stockholders' deficit, which was a negative $282.3 million. This essentially means the company owes more than it is worth to its shareholders. Now let's talk about how they've been performing financially. For the 3 months ending the 30th of June 2025, their net loss was a massive $32.2 million. And if we look at the first 6 months of the year, the net loss balloons to over $85 million. That is a lot of red ink, folks. Their total revenues are also quite low. For the 3 months ending the 30th of June 2025, they brought in just $5.5 million. And for the first 6 months of the year, it was around $10.3 million. This is concerning, especially when you compare it to their expenses. For the same 6-month period, their operating expenses were a staggering $83.3 million. So they spent over 8 times more than they earned. That is not a sustainable business model in the long run. This really shows up when you look at their net loss per S-hair. For the 6 months ending the 30th of June 2025, it was a negative $0.50 per S-hair. This means for every share of ownership, your stake in the company lost $0.50 in value during that period. Diving deeper into the notes, we see why their financial picture is so bleak. They've got all sorts of liabilities, including a whopping $327.7 million in current liabilities alone. This includes things like accounts payable, other current liabilities, and significant borrowings. They have $44.6 million in borrowings from related parties and another $53.1 million in convertible debts from related parties. That is a huge chunk of debt owed to people connected to the company. These related party debts are a major red flag. It means the company is heavily reliant on funding from its own insiders or affiliated entities. While sometimes necessary, this can create conflicts of interest and raise questions about the true financial health of the company independent of these affiliations. They also have $12 million in restricted cash. This is cash that is set aside and cannot be used for general business operations. While often necessary for specific purposes like escrow accounts, it further reduces the liquid assets available for day-to-day functioning. Looking at their assets, they have loans and notes receivables of about $637,000. This is relatively small compared to their liabilities. Their long-term investments are a bit larger at $27.7 million, but many of these are in non-marketable securities, meaning they are hard to sell, and their true value is uncertain. The company's borrowings are significant, totaling over $56 million, with a substantial portion, $44.6 million, coming from related parties. This heavy reliance on related party loans is a consistent theme and a potential area of concern for external investors. Their convertible debts are also substantial at over $35 million plus another $53 million from related parties. These debts can be converted into stock, which can dilute existing shareholders' value if not managed carefully. They have a TFI note worth about $46.3 million to a stockholder of the company. This note carries a high 15% interest rate and is payable on demand. The fact that it is payable on demand means the company could be forced to pay it back at any time, creating immediate liquidity pressure. There is also an exchangeable note for $6.8 million to Giant Wisdom Ventures Limited, a company controlled by a major stockholder. This note is secured by company stock, which means if they default, they could lose those pledged shares. Then there is the convertible promissory note with Yorkville, totaling about $35.4 million as of June 2025. The details around this note are complex, involving variable conversion rates and a significant legal dispute. It also appears that Yorkville has already foreclosed on some collateral related to this debt. They also have various warrants outstanding. Warrants are like options to buy company stock in the future. Some are classified as liabilities, meaning their value fluctuations impact the company's income statement directly. The company has warrant liabilities totaling nearly $1 million. Now let's talk about the mountain of legal troubles. The company is involved in numerous lawsuits and disputes. They have legal proceedings related to trademark infringement allegations of deceit and misrepresentation songwriter, and producer music publishing rights infringement breach of a commercial office lease agreement wrongful early termination of a services, agreement breach of a settlement agreement, and claims for unpaid compensation. They defaulted on payments related to a $3.6 million judgment from Sony Music Entertainment, and another judgment for $4.4 million from Sony Music Publishing Europe Limited. They also have outstanding contractual obligations to music labels and publishers totaling about $30 million for unpaid music licenses, and face threats of further litigation. There is a dispute over a commercial office lease seeking damages over $3.5 million. They have accrued $1.8 million but acknowledge the potential loss could exceed this amount. A Samsung arbitration award resulted in a judgment of $2.6 million plus daily interest. They have an agreement in principle to settle claims for alleged unpaid compensation for about $2.4 million, and a dispute with Bobby Sarnavest alleging breach of a merger agreement with an accrued liability of about $3 million. The most alarming legal situation seems to be the ongoing litigation with Yorkville again. This case involves claims that the company owes approximately $38.1 million including interest and legal fees. The company has transferred 3 million shares of BKFC stock as partial repayment, but the litigation continues. There is also an arbitration demand from 13,080 Advisors LLC for breach of contract and other claims, and a lawsuit from the former chairman Robert E. Diamond Jr. and Atlas Merchant Capital LLC claiming over $5 million in cash compensation and over 6 million shares of common stock. Looking at their cash flows for the first 6 months of 2025, they used $20.4 million in operating activities. This is a significant outflow, meaning the company is burning through cash just to keep its doors open. Their total cash and cash equivalents combined with restricted cash at the end of June 2025 was about $14.1 million. This is down from about $17.2 million at the beginning of the period. Their working capital deficit is substantial at $310.6 million. This means their short-term liabilities far outweigh their short-term assets, a classic sign of financial distress. Now for some truly worrying news, Triller Group Incorporated has received multiple delisting determination letters from NASDAQ. They failed to file their annual and quarterly reports on time. While they've been granted some extensions and have presented plans to regain compliance, the continued failure to meet reporting deadlines is a serious issue. And in a critical update, they received a delisting determination letter on the 26th of December 2025, confirming the suspension of trading due to not filing 2 periodic reports by the deadline. This means their stock could very well be delisted from the NASDAQ stock market, a major blow for any publicly traded company. In their management discussion, they admit they have a history of operating losses and negative operating cash flows. They estimate their current cash won't cover planned obligations for the next 12 months. They're hoping to grow revenue control expenditures and find external funding, but acknowledge there is no guarantee these efforts will succeed. And to add insult to injury, they have defaulted on approximately $70.8 million in principal amount of outstanding debts. So what is the story here? Triller Group Incorporated is in a very precarious financial position. They are burning through cash at an alarming rate, have massive liabilities, and are facing numerous lawsuits and delisting from the stock exchange. Their revenues are low and their expenses are sky high. The heavy reliance on related party loans raises further questions about their true financial stability. While they talk about future plans for growth and funding, the immediate reality is one of significant financial distress and looming delisting. It is hard to see a clear path forward without substantial new investment and a significant turnaround in their operational performance. Given the current situation, the risks are extremely high for any investor. What is your take on Triller Group Incorporated's chances to turn things around? Let us know in the comments below. If you found this deep dive valuable, give us a thumbs up and subscribe for more. And don't forget to join our Discord community linked in the description. Thanks for watching, and we'll see you in the next one.